That was indeed great conversation. Thank you, Mr. Ramesh Zamani and Mr. Utpal Seth. There was lots to learn from you and from some of these all-time great investors. We now move on to the second session of the day, the presentation Moats 2.0, and will be presented live by Mr. Pat Dorsey. To tell us what this session is about and to introduce us to Pat, I would like to welcome Mr. Paresh Thakkar. Paresh is managing partner at Value Quest Capital LLP. Paresh has over 25 years of experience in the field of investment management. He was one of the founding members of Religare Global Asset Management. He was also a founding member of Evolvence India platform, an India-focused hybrid private equity firm which raised and deployed over $300 million US. His earlier roles include head corporate development with Collabra and investment principal with Infinity Ventures Fund, New York. Paresh has played an active role in the Indian venture capital private equity industry since its inception and also served on the investment committee and advisory board of many leading private equity firms in India. Paresh is a chartered accountant, cost accountant, company secretary, and also a CFA charter holder. Over to you, Paresh.
Thank you, Gaurav. That was a very generous introduction. Thank you for that. And I also wanted to thank the CFA Society for providing me this opportunity to moderate Pat. It's always a pleasure to be part of any CFA event, and it's a special delight to speak to Pat today. Most of you know that Pat used to lead the equity research at Morningstar before leaving to start his own firm 7 years back. His firm, Dorsey Asset Management. He will tell you a little more about his firm in a few minutes. Just one more thing I just wanted to highlight. Again, most of you would have read his book, The Little Book That Builds Wealth, at least once, if not, a few times. And I just wanted to mention that I have personally benefited a lot by, reading his book. Has helped me kind of, my own framework. And I was fortunate to meet Pat a few years back when he was visiting India. I really enjoyed that session, and we have stayed in touch. It's always great listening to him, reading his letters, and speaking to him. I look forward to the session, and learning from his experience. So, his area of interest has been moats. Most of us know that he's always talked about moats from his days, and and his book. And as he has now started deploying money and his through his funds, his focus has now shifted to identifying reinvestment opportunities within moated business. And today's presentation, he's going to highlight the importance of finding runways in moated business, and he's going to talk about that. Maybe without any further ado, I will just hand over the session to Pat. Please in welcoming Pat.
Thanks so much, Paresh. It looks like you can't see my slides right now, so I'm going to give a moment to figure that. Oh, you could. Okay, we'll try that again. 8 a.m. here in Chicago, so the coffee is still kicking in. Let's give that a moment here. Screen 2, there. All right. You guys see the slides? You can. This is exciting. All right, rock and roll. All right, thanks so much, Paresh, for the kind introduction. Thanks to the folks at CFA India for the invite. I'm bright-eyed and bushy-tailed here at 8 a.m. in Chicago time. So just here's what the lawyers say. I'll give you a quiz later. You can memorize that. So quick introduction. I used to run the equity research group at Morningstar. I started my own firm about 7 years ago. We were founded in 2014. We've compounded at about 18% since inception versus about 10% for our benchmark. We're about 1.8 billion in assets under management right now, 6 employees, largely institutional clients, endowments and foundations, universities. We're very concentrated, 10 to 15 positions global. We can invest anywhere in the world. We are careful to only invest where we think we have a competitive advantage. Countries focus on businesses with economic moats and reinvestment runways. So not just companies that have some kind of competitive advantage, but that also have the opportunity to continue reinvesting that capital going forward. That's kind of going to be one of the main focuses of this presentation. well positioned currently with 40% of our capital in the top 4 position. And our process emphasizes primary research and qualitative insights. This is really important because assessing competitive advantage is not just a matter of reading financial statements. It's a matter of getting your hands dirty, getting out there, talking to customers, talking to ex-employees, and really figuring out routes why customers will allow a company to back economic lens from. So that's something I want to talk about later in the presentation. So we'll do a quick background on sort of what creates a moat. Those of you who read any of my books may be familiar with this. We'll go pretty quick. The primary test is pricing power, which is usually created via intangible assets, like a brand or patents or a license. Switching costs, network effects, or cost advantage. There are some exceptions there where an Amazon or a Costco might compete based on what's called shared scale economies. The general rule that if a business does not have some kind of pricing power, probably doesn't have a moat. In my view, why moats matter is that they increase business value. They lengthen the period during which a company can reinvest capital at a high incremental rate of return. Very simply, you can just for a longer period of time, it takes longer for returns on capital to decline down to cost of capital, and so the company can reinvest at an incrementally positive rate of return for a longer period of time. Moats also reduce business risk because they insulate the business from competition and exogenous shocks. And this is really important in the context of a concentrated portfolio, because if your average position is 7 or 8 and a big position is 12% versus 2 or 3%, those unexpected shocks can really hurt you. And so having the ability to have the business insulated from competition and unexpected shocks, again, not completely insulated, but to have that risk reduced is very beneficial. And that's one reason why we focus on moats and why I think a focus on moats is especially useful in a concentrated portfolio. Finally, moats can be inefficiently priced because a go-forward evaluation of competitive advantage requires qualitative analysis. You can't just click on Bloomberg and screen for switching costs. It doesn't work that way. You got to get out there and talk to people. And so because of that, because it requires real work from the analyst, well, a lot of the investment community doesn't do the work. And so if you do, you have the opportunity to develop a variant perception. So that's another reason why I think understanding moats and competitive advantage can be advantageous to the investor. And why reinvestment matters is that it maximizes the value of competitive advantage. It lowers the risk of value destructive capital allocation. And we'll give a couple quick examples to help illustrate this a little bit. So company A, 20% returns on capital, pretty good, but maybe its end market isn't growing very much. And so it can only reinvest 30% of its cash flow. It only has the ability to reinvest 30% of its cash flow because, it's selling candy, it's selling beer. The market's only growing 5 or 6% a year. So 70% of its cash flow is being used for dividends, buybacks, and M&A. Now, let's take a step back. Only a third of cash flow is actually earning that, 20% rate of return that got you really excited about the business in the first place, assuming incremental return on capital, equals cost of capital, of course. We also have the potential for value destruction because most repurchases, as we know, tend to be at overpriced levels. You have a small number of managers, CEOs who do this well, but the vast majority of companies deploy more capital to reinvest when the markets are hot. And of course, we all know the track record of M&A, generally pretty poor. Again, some companies who focus on it do it really, really well, but most companies, frankly, don't. And of course, the income that's paid out to me, the investor, has to be redeployed in a public equity market. It might be taxed, and so then we have tax leakage. But then I've got to go out and compete with a whole bunch of other smart guys, and women, some of whom belong to CFA Society of India or other CFA societies, and redeploy that capital. And that's a much less efficient way of using that capital that the business is generating than just reinvesting it back in. So let's look at company B. Same return on capital, 20%, return on incremental capital. It reinvests 70% of its cash flow, right? The market is growing at a reasonably fast pace so that it has the capacity to continue reinvesting. The most logical thing to do with that capital is to reinvest. And so the bulk of the cash flow actually earns that 20% return on capital that got you excited about the business in the first place. And you have lower capital allocation risk because there's really this is two figures, because there's one choice, which is to reinvest the capital, right? Plow it back into this wonderful business that's earning 20% returns on capital. And critically, the return on that reinvestment is higher than what's typically achievable in public equity markets. Just take a step back and think about it. The set of companies with sustainable returns on capital above 20% is way larger than the set of equity managers, yahoos like me, with long-term net returns above 20%. And if that's the case, then the most logical thing to do is to find the businesses that can keep reinvesting, because the capital is going to compound at a higher rate than if they give it back to you and you got to do something with it in a highly competitive equity market. That's, in my view, why reinvestment matters. So let's talk a little bit about analyzing reinvestment. Right? How do you think about whether this reinvestment is NPV positive? Because just because a company is reinvesting, it could be creating value or it could be setting the money on fire. One thing to ask yourself, is the investment incremental or fixed? Software and salespeople, this is incremental, right? You hire more marketing people, you stop hiring them, you hire more software developers, you stop hiring. But all the while that you're expanding, you're probably shipping code, you're probably shipping product, and you're generating cash flow. You've got an actual functioning business. Whereas if what you're doing is building a giant gigafactory or launching a bunch of satellites up into the air, well, you don't generate any cash flow until that actually happens, right? And so that's fixed investment. And of course, your drop through is really high once you get those satellites up in the air, or you finish the gigafactory. But if it doesn't work, or there's a delay and you run out of cash, or maybe technology moves forward and obsolesces your original idea. This is what happened to Iridium and Globalstar. Many of you remember those companies. They were going to launch a whole bunch of low Earth orbit satellites and create a global phone network for anywhere in the world that anybody was. But then cell phone technology advanced at a much faster rate, and the phones were bulky and inconvenient, and it was a lot easier just to pick up and use one of these things. And so they spent all this money launching these satellites, and nothing worked. So usually incremental investments are much less risky than fixed investments. The corollary here is that fungible assets, people, are a lot easier to pivot than fixed assets if the original plan doesn't work, right? If feature A in the software doesn't work, or if you're an engineering-centric organization and the product you're designing isn't very good, you just start doing something different, because people can do lots of different things. Whereas if you've invested a ton of capital in a factory that's just going to do one thing, and then nobody really wants that thing, you're left with what's called a stranded asset. So again, reinvestment in a fungible asset is usually less risky than reinvestment in an asset that has what we call high specificity, right? It can only be used for one thing. And then you want to think about the competitive response. You poke the bear, sometimes it pokes back. And so, when you reinvest, or when you're analyzing reinvestment, you want to think about what is the competition that may not exist today, but may be provoked into existing by that reinvestment. And then finally, is this reinvestment what we would call, widening the moat, extending the moat, marketing the moat, or is it digging a brand new one? Because generally speaking, extensions of an existing capacity, an existing skill set by a business is less risky than just starting a new division and going off in a completely new direction. Another thing to think about, and this is super critical. If you take one thing away from this presentation, take this away. Investment also happens on the income statement. There is a fundamental disconnect between accounting rules and economic reality in a digital world. Period. Sales, advertising, SaaS development costs all have to be expensed. But if you're acquiring a customer who makes your software part of their business, part of their workflow, and is probably going to have a 5, 10, 15-year lifespan, wow, that sounds like something that brings me a benefit in future periods. which also sounds like the definition of an investment. Same with SaaS development costs. When we had on-prem software, well, we still have on-prem software, but generally speaking, the accounting rules were you could capitalize R&D costs until the code was ready to ship, until you shipped a new version of the product. But if it's SaaS, it's always on. It's always available. And so you have to expense all those R&D, all those engineering costs, all those developer costs constantly. Can you really tell me that the efforts of every engineer at Amazon Web Services have no benefit in future periods? That they only have a benefit this year? It boggles the imagination, but that's what the accounting rules say. And that's why those investments are expensed. So you need to think about the fact that many of these expenses in some businesses are actually investments in future periods. And what that means is that future margins may be much, much higher than current margins because those investments will decline over time as the company gains scale. The corollary is that GAAP losses don't necessarily mean something's a bad business, right? Are some expenses actually investments? And then maybe cash flows are actually higher than GAAP income. A lot of companies that have negative working capital, they may be generating great cash flow, but these really ugly looking net income losses. And then we have expensing stock options. Again, expensing stock options causes a huge hit to the income statement, but often there's a cash inflow to the company as the company is generating, as employees are exercising stock options. And then critically, are structural long-run margins actually higher than current margins, right? If a company is acquiring customers who are going to be around a long time, well, it's a lot cheaper to keep a customer than it is to acquire a new one. So over time, as the proportion of new customers to existing ones declines, margins probably expand. And so just because a company's posting, I get this question all the time, like, Pat, why do you invest in all these money-losing businesses? As if, money losing means, satanic. And they're money losing because they're reinvesting. They're money losing because they're making a high NPV reinvestment in the future. The corollary here is that quantitative metrics sometimes are not of a high value in analyzing whether a reinvestment is NPV positive. Because if invested capital is minimal, if you've just been hiring software developers and salespeople and you don't have much invested capital, if your denominator is zero or not very much, well, even a company making a really bad reinvestment decision may have a high return on capital, right? Return on capital, ROIC, is no longer the canonical test of competitive advantage. And also, if a high NPV reinvestment is expensed, think about Amazon building out a warehouse or building out a logistical network. That all gets, well, in the case of trucks, it gets expensed, but it gets capitalized. In the case of developing the software to figure out where a package should go, that usually gets expensed. A declining return on capital may indicate a brighter, not a worse future, because a software company or a technology company that's not reinvesting has a static product that's more likely to get disrupted. Qualitative research methods are more likely to produce robust answers here than just looking at the financial statements. Another corollary, limited reinvestment opportunity doesn't mean it's a bad business, okay? A business that is mature, that's not growing very much, that has to pay out lots of cash flow or do M&A, this is not a bad business. It's not what we invest in, but that doesn't make it bad. I mean, I don't eat, artichokes very much. Doesn't mean artichokes are a bad vegetable. Capital allocation just takes on greater importance as a source of value creation or destruction. You have to, as the analyst, spend more time thinking about the capital allocation acumen of management, their ability to do intelligent M&A as opposed to defensive bad M&A, their ability to buy back stock at appropriate levels as opposed to at high levels. It's more important when the business does not have a lot of reinvestment opportunities because it's got cash it's got to do something with, so it can't reinvest it. So you've just got to spend more analytical time on that topic. Destructive M&A is, as you know, is usually the biggest risk. And there are a small minority of companies that really focus on M&A, that make it part of their DNA, who they are. They measure the results of M&A relative to their initial expectations, they learn from that, and then they iterate over time, that requires focus, right? M&A that's just the result of an iBanker giving you a PowerPoint and the CEO says, wow, that's a great one, let's do it. That usually doesn't work out so well. But when it's a consistent, it's consistent small M&A that iterates over time and it's part of a learning process, that can create real value. So let's shift a little bit to some topics kind of that are related to reinvestment that are more about what I would call looking forward as the investor as opposed to looking backward. So one is that lower turnover as an investor does not mean better investing, period, and full stop. I think turnover has been put on a pedestal in our industry, and people think that just because, oh, I haven't bought anything in 2 years, my favorite holding period is forever. That makes you wise. No, it doesn't. It's a choice. It may be a good choice, but it may be a bad choice. It's not just canonically good. One of the reasons I think low turnover gets fetishized in our industry, frankly, is peer pressure. We had this guy in Omaha who said once, my favorite holding period is forever. Well, maybe if you made the exact right decisions day one with what you own, and the opportunity set either never changes or there's never a better place to deploy the capital, then yes, the best holding period is forever. But not all of us are smart enough to make the exact right decision the first time, and the world changes and different opportunities evolve. Okay, apologies for that. I'll start over with this slide. I'm not sure why the internet decided to not be happy here in Chicago. So there's a lot of peer pressure in investing. We kind of fetishize lower turnover. And that's one reason why I think, my favorite holding period being forever only makes sense if you've made all the right decisions right at the get-go and if the opportunity set never changes. And then the coffee mug experiment at the University of Chicago that illustrated what's called the endowment bias, where we place irrationally higher value on what we own than what we don't. It occurred this way. So Richard Thaler held up a coffee mug and said, okay, class, how much would you each pay for this mug? Here, please write it down on a piece of paper. And the average answer was $2. We'd pay $2 for this coffee mug. Okay, great, thanks. The next day, he asks a different class, they're all still, 19-year-old college students, so pretty much the same demographic. He gives them each a coffee mug when he walks in, and when they walk in. And then he later asks, okay, what would it cost me to buy this back from you? Generally, the answers were between 10 and 30% higher. It's the same coffee mug. If we were completely rational humans, it should be exactly the same, right? You should be willing to pay the same and have it bought back from you at the same amount. Not the case. We tend to irrationally value what we own. So psychologically, the impact for the investor is that it's hard to sell something you own and are familiar with and buy a less familiar asset, even if it has a potentially higher return. And so I think as investors, we need to act flexibly and we need to think carefully about the opportunity set that's in front of us. Sometimes low turnover is the best choice. But if you are wrong, you need to admit a mistake and move on. Or if you're really right and the asset you own rises very quickly in price and there are better opportunities out there, low turnover may actually be harming your clients and your results. Change is constant. Sometimes you're wrong, sometimes you're right. And the opportunity set is always changing. So again, I'm not telling you all to go out and be day traders. My point is simply, let's stop putting low turnover on a pedestal, because low turnover is an output of good decisions. That's all it is. It's an output of decisions. It shouldn't be an input. Underwriting a long-term horizon, right? Thinking about the long-term cash flows of the business when you originally purchase it, that is an input. That is the long-term perspective. But that may result in low turnover, or if you're wrong, or if you're right, or if the opportunity set changes, perhaps it results in selling the business after a few years or 6 months because the world has changed or because your initial assessment was wrong. Quote from one of my letters. Our favorite holding period is not forever. It's the one during which we can earn an excess return. And honestly, I think that's just a more rational way to think about things. If the period during which you can earn an excess return with the security you own turns out to be very long, super. If it turns out to be fairly short because you were wrong, you were right, or the world has changed, well then the best choice for you and your investors is to redeploy the capital. Let's talk about moats and looking forward. In a mature industry that generally capitalizes investments, backward-looking quantitative evidence may suffice to assess competitive advantage, because returns on invested capital have analytical value, and the past may be a decent guide to the future, right? If you're capitalizing and you're reinvesting, it's not expense investing. ROIC is probably a meaningful number to indicate whether the business has competitive advantage or not, and the past may be a pretty good guide to the future if it's a fairly mature industry that's not changing a whole lot. But that's the problem also, because if the evidence is there for everyone to see, the moat is probably efficiently priced. If it's clear to everyone that it's a wonderful business and is going to continue to grow at 8% a year or whatever, you don't really have a variant perception. And the odds are you're not going to earn an excess return. Now, of course, if consensus expects flat and you expect something better than that, and you can develop a variant perception, then you may be adding value, right? But if you're just seeing what everybody else is seeing, you're unlikely to earn an excess return. But in a dynamic industry that generally expenses investments, past quantitative data has pretty limited value. ROIC is frankly meaningless if there's little invested capital and if investments are often expensed. The industry is changing rapidly, and past may be a really bad guide to the future, right? But this, my friends, is the opportunity. Because if the moat is not obvious, if the company is still building its moat, if it's not in the numbers, you can develop a variant perception using qualitative insights. And that's the really fun part. The value of qualitative insight is that the outputs may be quantitative. The outputs of all these things, capital allocation, reinvestment, may eventually show up in the numbers, but the inputs, whether the company is taking the right actions today to create value in the future, all require qualitative evaluation. Because you can't screen for switching costs. You can't click a button in Bloomberg and have it tell you whether customers have a hard time switching from product A to the competitor's product B. You can't assume reinvestment is NPV positive. You've got to analyze the long-run economics yourself and make a judgment call. And you can't rely on the warm comfort of published numbers. You have to go out into the real world, gather messy and conflicting qualitative evidence, piece together a mosaic, and make a forecast that may look very different than the past. That can be really hard. It's hard to go to your boss or the PM or whatever and say, look, I know this company has never made any money, but it's going to do 500 million in free cash flow in 3 years because of the operational leverage driven by A, B, and C. That's psychologically really hard to do, but that is where the value is. That's where you develop a variant perception and create excess returns. And so the message here is to turn off your laptops, because all of the information, all these published financials, they're in the past, but all of the value that your investment could create for your clients is in the future. Quantitative data is, in my view, usually priced pretty efficiently. Lots of clean data sets out there, lots of PhDs running quantitative, posting it. Pretty hard to beat them. Qualitative insight, that is less. Because if you go out and talk to 6x salespeople, and they all tell you, well, no, in bake-offs, you win 80% of the time, you may be one of a very small number of investors who know that. You're one of a very small number of investors who did the work to talk about it. That's what value really is. And I would really encourage you, especially if you're thinking about reinvestment, if you're thinking about kind of more what I would call dynamic investing, get out there and think about primary research, self-source your own contacts, and develop that qualitative insight, because you're more likely to develop a variant perception. Thanks.
Thank you, Pat. That was a wonderful presentation. You highlighted the reinvestment so well, and I think your articulation of the need for a variant view of the moat was very well done. I think that was brilliant. Maybe it would be great, Pat, if you could talk through a couple of examples through your experience, your thoughts. And I was wondering, maybe we could start with a couple of your portfolio investments. Maybe we could speak about Walt Disney to with. You normally write in your letters that or that in your investment philosophy there are a few you would look for. One is, of course, existence of a good track record of capital allocation, a growth runway, which is very important for value creation. And last not but the least, you would talk about the need for a reasonable valuation framework. Using the Walt Disney example, Pat, it would be great if you could touch upon your investing framework.
Yeah, sure. I mean, so Disney's interesting because the future very well could look very different than the past, right? Historically, Disney's created value by creating but not really distributing its own content, right? The direct relationship with the consumer has occurred, at the parks. But the movies, went into movie theaters, and then you turned on your TV and maybe you watched an old Pixar movie. But the advent of streaming technology means they can then basically cut out the middleman. They can basically tell the cable networks to all go take a hike. We are going to stop paying you a lot of economic rents, and we're going to develop a direct relationship with the consumer with channels like Disney Plus and Hulu. That becomes really interesting because, first of all, you're not giving up a whole bunch of economic rents to the cable networks. So there's more money for you. So that's interesting by itself, right? The other thing that's interesting is you're developing exclusivity, right? Because if you think about, there might be 2 cable operators in your neighborhood, and they've both got, channels that have Disney content. Well, so what? You can use one, you can use the other. But if Disney Plus is the only place you can watch Marvel or Star Wars, that sounds like a monopoly. That sounds good to me in terms of pricing power, right? And so, but it requires a lot of reinvestment, right? Because if you have to keep rolling out new content to keep people onto your platform. And then the drop-throughs can be very, very high. So you think about it, the amount you need to spend on content to attract subscribers, 100 million to 200 million is a lot higher than what you need to spend to get subscribers 200 million to 300 million, right? Because you've already got a whole bunch of content. And so that means the drop through becomes much, much higher. You make more money on each incremental subscriber. And so that's kind of the reinvestment angle. And that's what Disney's doing right now very, very heavily. The capital allocation is an interesting question. Obviously, Bob Iger did a phenomenal job with buying the Marvel franchise, buying the Star Wars franchise, and then I think less well recognized, buying BAMTech, which is a technology platform that serves as kind of the core of Disney's streaming technology. Now, in theory, the assets are there, right? There shouldn't be the need for lots of M&A going forward. And so it's all going to be about internal capital allocation, creating the right content to attract people. That is a little bit uncertain. And Disney's got a great history of it. The DNA is certainly there, but people make flops all the time in the entertainment industry, right? And so that's why, you need to make sure you have the margin of safety so that your capital doesn't get impaired in case, for whatever reason, we roll the clock forward 5 years and Disney still got Marvel and Star Wars, but not much else.
Interesting. Thanks, Pat. And how did you think about, the valuation framework in case of, and, especially in light of the fact that, Disney is like a well-known moat. So, what did you think was your, qualitative insight, which gives you kind of that variant perception, which is not priced in?
That's a great question. So basically, Disney 2005 looks really different than Disney 2000. It is kind of, or 2025 looks very different than Disney, 2018 or 19. And that's where the variant perception comes in, because all that reinvestment is happening today in content to build out the DTC library. The economics right now look terrible, right? But our view, based on talking to a lot of people in the industry, is that the eventual margins for DTC are going to be extremely attractive. And so that business will generate the bulk of Disney's cash flow 5 or 6 years from now. Now, we could be wrong, but that's the variant perception, is that it's going to be a much more profitable business than I think most people suspect. Partially, and again, the variant perception comes from the fact that there is no scale streaming platform right now. You have Netflix, but Netflix is really only scaled up in the US. It's not really scaled up globally yet. It's getting there, right? And so the modal investor doesn't have an analog to put their head onto, right? You can say, okay, wow, enterprise software companies, they usually have 30, 40% margins. Okay, great. But there simply isn't a streaming platform yet with 300 million subs. It doesn't exist. And so that means that if you can have a forecast on what that looks like in terms of cash flow and margins, and you're right, which is important, there's your variant perception.
Yeah, thank you, Pat. That was very interesting. Just using the example of the capital allocation, but since in this case in Disney there was a change of management, so I was thinking maybe we could visit another portfolio investment of yours where there has not been a change of management, and it's a very popular business in India. I thought we could speak about Facebook. In your letters, when you normally talk about management, framework for management, you talk about the need for unity, need for passion, rationality, alignment, and talent. In that framework, how do you kind of think about the Facebook management?
Yeah, so I think Mark Zuckerberg has learned a lot. I think that if we look at some of his statements around the time of the Cambridge Analytica scandal in the US, they definitely were those of somebody who, frankly, hadn't realized how powerful his company had become, right? They were the statements of an engineer and an entrepreneur. And so this is someone who I think has grown a lot over the past few years and has done a good job bringing in external talent to help manage some of those challenges of being a global player. The most critical one on that front was Facebook about 3 years ago hired a guy named Nick Clegg, who used to be Deputy Prime Minister of the UK, to basically run their global policy operations and sort of manage a lot of the external messaging, the relationships with policymakers, And I think that was really important because it really, he's got a history and experience in dealing with thorny, complicated issues that really don't have good answers, right? Like shipping code, there may be a right or a wrong answer. Like we should do the code this way or that way. But how do we moderate content? How do we think about balancing the First Amendment rights that we have in the US for free speech versus the responsibility to not show really unpleasant and content to people? Those don't have right answers. Those are difficult, right? And I think bringing on Nick Clegg has really helped manage some of those. So yeah, I mean, look, ideally the company would have made this, I wouldn't say pivot, but sort of added more emphasis on privacy and security and safety, and kind of, had that conversation on an equal level with the folks who just wanted growth. Ideally, that would have happened a bit earlier than it did. Didn't, but it has now. And I view Zuckerberg, I think, very differently than the popular media does. I think that generally he's been a pretty good steward of capital.
Great.
Although they should buy back more stock, I will say that. They should buy back a lot more stock.
We spoke about Disney, we spoke about Facebook. I was wondering if we could also speak about a B2B business in your portfolio, just to contrast. How do you kind of differentiate between your research process for a B2B and a B2C business? And I was wondering, maybe we could touch upon Temenos, which is a banking software business. Has its biggest competitor is an Indian listed company called Oracle Financial Services. And maybe we could just touch upon the contrast between a B2B and B2C business.
Yeah. So it's interesting because I think a lot of investors, they're more comfortable with B2C businesses because they have a familiarity with it, right? They watch Disney themselves, or they use Facebook, or they have friends who use the services, right? I'm actually not as much a fan of them because, I can go out and talk to 1,000 Facebook users or 1,000 subscribers of Disney Plus, and I've learned nothing, right? Because those people are a tiny fraction of the actual number of users. Whereas for, say, Temenos, which is, manages, makes ERP, think of it as an ERP system for a bank, right? It's basically the core that makes the bank go and balances the books and sends out statements and everything. Stuff that you can't get wrong. I kind of figured out the business, right? And so, if I go out and talk to 12 engineers at large banks about Temenos' strengths and weaknesses, and they give me kind of the same story. The investment that's required to climb the learning curve to be able to ask those intelligent questions. They roughly kind of point me in the same direction about what it does well, what it does badly, whether it's easy to switch or hard to switch. I don't know. I think the research is actually easier.
Thank you. That was very interesting. Pat, just one more thought. You speak about, gaining qualitative insights, switching off your laptop, being on the road, being in the field. I know, in the past when we've spoken, you said that, you probably kind of attend, between you and your team, a few dozen industry events and, trade conferences, or so on and so forth. It would be great if you could just, share your experience. Why do you find it important? And if there is a kind of a particular moment which you kind of can recollect from, which was relatively a turning point for you to either buy something or sell something, which is, or if there was, so to say, a eureka moment through this work.
Yeah. So I guess, yeah. Okay. So great. It's a good question. So here's a good example. We used to own, and should still own, but we sold it too early, a wonderful little software company in the US called Workiva. So quick history. So the way it used to work, if a company wanted to submit a financial filing to the Securities and Exchange Commission in the US, is that you would create a big PDF, okay? And then you would send it to a financial publisher. and they would format it, and then they would send it back to you, and then you would change it, and then you would send it back to them, and blah, 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 blah. And every once in a while, they would send it to the SEC sooner than they were supposed to. And then you got very angry at them, right? And as a CFO, not having that kind of control gives you hives, right? So about a decade ago, the SEC began to require what's called Xbrl tagging, basically sort of tagging in the filings that enabled them to be created electronically. So what Workiva developed was basically Google Sheets on steroids, so that your real-time collaboration and cell-level permissioning. So I, as the CFO, could say, okay, so-and-so, head of HR, you have permission to change these cells that contain the number of employees. You can't change anything else, right? Because you don't have responsibility to. And I could audit. I could go back and audit at the cell level. This is like manna from heaven, right? And so we went to their user conference, and people said, literally, I would not work for a company that did not use this software to do the external provider. Well,
that's really amazing. Yeah, that's a great
right?
insight.
I mean, they would say things like, this gave me my life back at the end of the quarter. Okay, that's awfully interesting. Yeah. Anyway, so but that was a case where you just had to go talk to the users, right? Documents is not massive, right? Even a huge company like Walmart, it doesn't have hundreds of people doing this. It might have a couple dozen. They were able to expand into adjacent sort of regulatory and compliance-oriented markets in a much more robust manner than we thought. So we sold it too early. But that was a case where it was just going to the user conference.
Yeah, go as per your hypothesis. Would you be willing to kind of talk about, some of your
think of it as a booking.
Interesting experience. Yeah. Oh, great. So, Pat, investments, or at least one of your investments which didn't go as per plan, and you're learning from that.
.com or Expedia in Brazil, Argentina, and Mexico. So
we spoke about Facebook, we spoke about Disney, Temenos, as
yeah, so I mean, probably we finished selling pretty recently a company called, they had a couple of advantages over Booking and Expedia in the region. One was a pretty strong brand name.
It is sometimes nice to learn from experiences where
and because the offline to online transition is in earlier stages in those countries, that brand has a stronger value than it might be in the US or the UK. They also had the ability to allow people to pay in installments, which is a very popular way of paying for a high ticket good, like a vacation in Latin America. Couldn't do that on Booking or Expedia. And then they also offered packages, which were often at a discounted rate because the hotels could offload rooms at a lower rate without provoking a competitive response, right? Because the pricing was opaque because it was buried in a package. So these were kind of the advantages the company had. It was trading at what we thought was a pretty cheap price, had a long runway. Travel keeps expanding at 6-7% a year. And the offline to online transition was in its early stages in Latin America. So a few things that caused it to not work out. One, well, we had this global pandemic that took travel volumes down to zero. Didn't foresee that happening. But the company had a really poor response. It didn't manage its brand very well, in our view, during that period. Customers didn't get refunds in a timely manner. And so that meant that when travel volumes do come back, we felt like they wouldn't get maybe as big of a share as they might have had they managed that process better. Also, the competitive environment shifted faster than we thought. We thought the likelihood of Booking.com, rolling out a payments platform and creating installment capability was pretty low. And as it turns out, they've been really they've been investing in their own payments capabilities. They haven't rolled out installment capability yet, but they're developing the infrastructure to do so. And so that's something that we tagged as a low probability scenario, turned out to be what happened. But the biggest lesson for us, for Despegar, is that consumer-oriented businesses in markets where you don't live and don't experience the culture on a daily basis, you're not necessarily in as advantaged a position as an investor. Right now, about 40% of our portfolio is non-US, but like one of them is Temenos, which we talked about. Yes, it's a Swiss company, but it sells globally. It's not like I have to understand Swiss German to understand the company. We own a company called Amadeus, which is a huge player in the global airline infrastructure industry. Sells software that helps airlines manage their seat capacity. It is technically domiciled in Madrid, but it's no more Spanish than I am. So it's a global business. We own Nintendo, again, a global business. And so, one lesson the big lesson for us with Despegar is just to be very cautious whether a company that's operating in a culture where you don't live and don't experience on a daily basis, is that really within your circle of competence? It may be. I have an old saying that you often say no, but never say never. But same.
Yeah.
Sorry about that, Paresh. I not sure what the groundhogs are doing digging around our fiber network here.
No problems. Pat, again, thank you for being candid and sharing your experience, across your portfolio companies. I was just, one more thought. Stress on the importance of pricing power in the presentation. You said, no pricing power, no more for most cases, except for where you are scaled economies like Costco and Amazon. But many of the business, in some businesses, it's relatively easy to evaluate pricing. When it's like kind of a simple B2C business like a Nestle or a Coke. But there are other businesses. You mentioned Amadeus, you mentioned Temenos, and even in case of Disney, where there are multiple streams of business, Facebook. If you could share the nuances that you have observed while you're trying to evaluate pricing power across some variety of businesses, that would be great for the audience to learn from.
Yeah, I think a lot of times pricing power, it's really as easy as talking to a customer and saying, when's the last time the company raised prices on you? And they'll usually tell you. And if the answer is 10 years ago, well, it may not have a lot of pricing power, right? For some companies, you often have pricing is built into the contracts, right? You have 2 to 3% escalators, and that's something you can learn from customers or from ex-employees, or sometimes the company will just tell you, right? But another way to do it is you basically, and this is more understanding what I would think of as latent pricing power, is ask customers how much they pay for it and when the last time is the company raised prices. The example here is I'll bet you every single person on this call knows exactly what they pay for their Bloomberg, or their firm pays for their Bloomberg. And they're probably not real happy about it, right? And if somebody knows exactly to the penny or the rupee what they're paid, well, it's on their mind, right? And that means there's probably not a lot of what we would call consumer surplus. Whereas we invested in a company interesting recently that has some very good tools in digital advertising, and most of the customers couldn't even tell us what they paid for. They're like, I don't know, a couple grand, I'm not sure. But they all also said, it's critical to my work, and they could raise the price 20% and I wouldn't care. That's pretty interesting, right? That indicates there's probably a lot of latent pricing power that the company could take. And so I think some of this is just you can understand it explicitly with are there escalators, or when did the company last raise prices? But some of it is also just what's the consumer attitude towards the product, right? Do they feel like it's abusing them? In fairness to Bloomberg, the product does get better every year, right? They do a good job reinvesting in it. The ones where you're really, I think, in trouble is what I would think of as legacy software packages that milk the consumer, right? They don't reinvest, but they know it's hard to switch, and they just keep hiking the price every year. That's where eventually what they're doing is they're creating a profit umbrella that makes it, more lucrative for a potential competitor to show up and do something new.
Great. Thank you. That was very helpful. Pat, when you kind of think about governance, and as you evaluated, the functioning of the boards or the governance specifically beyond, the management team, is there anything particular which you kind of thought is very important, should focus on, or any sites as you evaluated functioning of boards and management?
Yeah, so I guess, and what I'm about to say is in the context of a concentrated portfolio. Obviously, if you're doing 2 and 3% positions, you can take more risk, right? Our general attitude is if we need to ask questions about the composition of the board, or we need to worry about this stuff, we probably shouldn't be investing. I mean, I'm totally serious, right? That it's the kind of thing where it's a big world, there's a lot of opportunity, and we just cannot take that tail risk of something going pear-shaped with regard to corporate governance or nefarious value extraction. We never understood how Wirecard works, so we never even looked at it. There's a lot of businesses that we've, and then in fairness, there's some businesses like Carvana that we passed on completely for corporate governance reasons, and it's just gone to the moon. All right, well, maybe we were wrong, or maybe just the sham goes on longer than we think. That's okay, right? I can't, I'm not going to worry about the one that got away. But yeah, I would just say that, I guess I would say the biggest thing is, so it's 2 things. One, make sure you separate alignment and competence. There are lots of very intelligent and capable CEOs who just didn't have the good fortune to be there at the beginning, right? They showed up at the company 5 years after it was founded. So they're not technically aligned in that they own 30% of the stock, but they're pretty dang good managers. And you got plenty of founders who still own a lot of the company, but probably shouldn't be in charge anymore for any one of a number of reasons, right? And so you just want to separate those two, right? There are very competent people who may not have exactly the alignment you want, and there are people who are super aligned but may not be very competent.
Great. Thanks, Pat. That was interesting. Pat, how do you think about when you look at balance sheets and this, and when you see, debt on a balance sheet of a company that you're investing, what's your first reaction? What's your second reaction? What do you think about debt?
The bulk of the companies we own, we typically don't own companies that have much debt because they typically don't have a lot of assets. We own a lot of digital businesses, and no bank in their right mind is going to lend lots of money to a company whose main assets are engineers that walk out the door every day, right? And so the companies we own typically don't have a lot of debt. Disney has some, that it has, and so that's something that we do think about in terms of their capacity to reinvest. How much capital is available to them, and then also their ability to potentially do value creating transactions in the future, like buying out Comcast's stake in Hulu, right? So then it's kind of that's a relevant thing for us. But to me, debt is like, it's a personal choice. I mean, I know very smart investors who they're just very comfortable with companies running very high leverage because they really understand how to read the covenants. They're comfortable with it. Maybe they don't have as concentrated a portfolio, so the risk of things going, that financial deleverage in the bad state of the world is just lower for them. And again, I respect that. It's not an area I have a ton of experience in. And so it's one I've just never been super comfortable with very levered companies. And fortunately, in the world that we traffic in, sort of companies participating in digital transformation, most of them aren't levered anyway, so it works out. If I really, really liked utilities and cable companies and I also didn't like debt, I'd kind of be in trouble.
Pat, there's one question from the audience, and they wanted to know whether you have ever invested in IPO and what's your thoughts about investing in IPOs.
Oh, IPO, sure. So yeah, I think that IPOs can be very interesting because anytime there's less information available to the market, you have a greater opportunity for a variant perception, right? And a company comes public and you've only got 2 or 3 years of published financials. And so people, it has more probability of being mispriced, either too high or too low, right? And so that gives you the opportunity to add value as an analyst. And also, of course, companies are coming public later in their lives now. They're staying private longer, which is annoying public investor because it means there's all this value creation that gets captured by the venture capitalists and by the kind of private guys. But it also means that when it does come public, you've got a more complete entity to analyze, right? It's a company that's been around for a while. It's got customers who may have used the product for 5 years. It's not a science project. That kind of makes the analysis easier. So I think that just ignoring IPOs as a class is a mistake, especially because they're often some of the most dynamic businesses going. Blindly buying one because the pitch deck looks good, that's also a mistake. You've got to do the work. And there's 2 possibilities, right? One is that it looks expensive, but based on the growth runway, actually isn't. And the other is that it is too expensive, but doesn't mean you should ignore it, right? Because a lot of times you get people who will sell a lot after the IPO, right? Some of the private shareholders, or because of that kind of limited history of the business and it may be generating a ton of cash, if you just hit a bad patch in the market, people get worried about inflation or interest rates or whatever. Stock price might be a lot lower 6 months or 12 months from now. But if you didn't have it on your radar screen, you're not going to be looking at it.
Great. Thank you. Now, another question from the audience, Pat, is about your portfolio construction and portfolio sizing. You mentioned in your presentation you have a concentrated portfolio between 10 to 15 positions. So give or take, on an average, you are probably investing between a 6% to a 10%, or 12% in a position. So do you kind of, once you have underwritten your hypothesis, would you go to your full position size on, immediately? Would you kind of build it up over a few quarters? Or any other thoughts on your portfolio construction and size?
Yeah, so what we do is we have a framework and we start from kind of the assumption that, so we have a qualitative checklist, just 5 points, kind of, what's the moat, what's the vector of the moat, and a few other things. It's nothing rocket science. And then we obviously have some expectation of what kind of returns the business could generate, right? What's the difference between what we think it's worth and the stock price today? And then you marry those 2 things. And what we do is we just say, okay, so if it's a perfect business, it scores perfectly on our checklist, and it has a very high expected return, then our hurdle rate is 15%, and that might be a very high expected return might be 30%. Then that gets a 15% position, right? So that's a max position for us. And anything worse than that, we kind of discount from there, right? And so a business with, say, a 20% expected return, but that's also perfect, might be a 12% position. A business that has a very high expected return but doesn't score well on the checklist, that's also maybe a 10% position, right? And the point being that none of this is perfect, but it gives you a framework, right? Because then you can look at the portfolio as prices move around and say, hey, these two companies, we expect about the same return for them. They're kind of similar on the quality score. Why is one 12% and one 7? Huh, right? It just kind of forces the question, right? And forces you to be consistent around how you think about businesses. And okay, you can't capture everything in a DCF. You can't capture everything in a quality firm. There's always going to be, exogenous factors, new research that you're doing, whatever, that might not be incorporated yet, but at least gives you a starting point that I think is way better than gut feel around kind of like why do we size things the way we do? In terms of how we get there, we don't scale into things. Like the way I think about it is if you do the work, you understand the business, and you make the decision, right? And if things change, the price goes down a bunch, or you discover new information that makes it worth more, then you change your position size. But I don't really understand the idea of kind of scaling into a position deliberately. I mean, like starting at 6 because it's only a little bit above your hurdle rate, and then buying more when the price goes down. Well, that's rational. But you're not. You go into it saying this is a 6% position, and then information changes, and the information is the stock price going down. I've never really understood why people say, yeah, we kind of scale into things, even if things don't change, right? Like if you've done the work and you're committing the capital, commit the capital. I don't know. That's just me.
Thanks. Another question from the audience is over the number of years, as especially since the last 10, 15 years, with more advent of more digital businesses where the outcomes are like outcomes is very wide, in contrast to the past where there would be step changes to businesses in a particular year. Has investment framework or checklist change in any manner?
Yeah, I would say not so much the framework itself, but more the focus. So when I was at Morningstar, we had 90 analysts, each covering 20 companies, and we didn't really have the resources to be calling customers and going to trade shows. It just wasn't. We were kind of a startup inside of a large company. Morningstar had never really covered stocks before, and so I think because of that, our focus at Morningstar was a bit more on established notes. That then became mispriced for reason A, B, or C. Whereas, partially as I've evolved more as an investor, and partially as I've just had the resources and the capability to do more of that qualitative primary research that helps you to gain comfort and understand how a moat is being built, right? How the future may look different than the past. That's where the incremental focus on reinvestment has come from. Because it's also, frankly, just easier to add alpha there, I think. So it's not so much framework, it's more kind of where I focus the X number of hours I have per week to do my job.
Okay. Pat, you visited India a few years, and I'm aware that you're not invested in India so far. Would you like with the audience and all of us, your perception about India, what kind of businesses you like about India, or if any thoughts you have on the Indian investing landscape?
Yeah, so I mean, that was kind of I spent 2 weeks in India, and it was kind of a fact-finding mission, and it was sort of could we get there was the question, right? Like, could India be within our circle of competence? And as the Indian public equity landscape, I would say most of the companies are endogenous, right? They're consumer oriented. You have some of the Infosys of the world that are doing that are more export oriented, but the bulk of the landscape, right? Whether it's the auto companies, the motorcycle companies, the CPG companies, the banks, the people making the decisions about the products are Indian. They're located in India. They're in a specific context, economic and cultural. They speak specific languages that we may not necessarily speak. And so that means our ability to diligence them is low relative to everybody else who's listening right now. Who probably has a competitive advantage over us in analyzing those businesses. And so that was kind of the biggest reason why we really haven't spent much time on it yet. We don't think it's really within our circle of competence right now. I would say the one thing that really did kind of strike me while I was there was I visited, I think 17 or 18, 17, that sounds right. And it was not long after Geo had come in and really brought down data prices, mobile data prices, just I think by 80 or 90%. I don't remember the exact number, but it was tremendous, right? And that's really interesting in terms of product proliferation, because it means that all kinds of services become available that frankly there wasn't a market for them before. Whether it's streaming video, whether it's apps that do X, Y, or Z. And again, that was super interesting. It's something to watch and be aware of. But none of those companies were public, and our ability to analyze them is low relative to somebody who's on the ground and observing consumer behavior in the competitive landscape on a daily basis.
So it's a relief for me and my friends that we won't have competition from Dorsey Asset Management in investment landscape.
We will not. No, I mean, look, it's a big world, and that is a pond that you are going to understand way better than we will.
Just joking. Thank you. I know an interesting question from the audience. It's been a while since you wrote your book. Our friend who has written the question would of course like to see another book from, but till such time that we get another book from you. His question was, whenever you revise your book, what would be the key thoughts or any particular message that you would like to revise?
Yeah, so I guess a couple things. One, I would probably mobile. I'm just saying, I mean, for a huge company that's established, it's really about more the moat than what the management. Revise the comments about management, it's doing with it. But for companies that are still growing, companies that are in, because I think those comments that I made with management being less important than the moat, do obtain industries that are changing very rapidly. Young companies, management can have, for mature companies, what the heck's the CEO of ExxonMobil going to do? A huge impact, right? And so I think I would want to revise that section just to, really, it's just, I'm not picking on Exxon, put some nuance and context around it. And I think I would also probably write more about reinvestment, write more about sort of, some frameworks and lenses through which to analyze reinvestment.
Great. Yeah, we look forward to the revised book whenever you get the chance.
Yeah, I would say writing a book is a low ROI endeavor. So the return on my incremental capital is probably higher to serve our clients.
You're underestimating the value that will create for all of us, but yeah, at your convenience.
Yeah.
Pat, you in your letters, in your conversation, you mentioned about that you use a qualitative scorecard. Of course, you spoke at length about the qualitative insights. If you could describe your qualitative scorecard,
Yeah, I mean, look, look again. This works for us, right? And I think one of the things about investing is that people can be very proscriptive and say this is the right way to invest, right? You should only do this. I mean, it's like saying there's only one kind of food, right? Like it's like saying there is no cuisine but Indian cuisine or Italian cuisine. It's stupid, right? There's many paths to heaven. So for us, what works, again, in the context of a concentrated portfolio, we think about the moat, like what's the current strength of the competitive advantage? What's the vector of the moat, i.e. is the competitive advantage increasing or decreasing? And this matters because all else equal, you'd rather own a business with not much of a moat, but that's building one, than with a huge moat that's deteriorating, because you're going to get paid on the future, not on the past, right? we look at the alignment of management and then the strategic acumen of management. Again, two very separate things in our view. And then the length of the reinvestment runway. All else equal, a longer reinvestment runway is more attractive to us. This is what works for us. I would say that if, if we had a broader investment universe, and by broad, I don't mean we can invest globally, I mean broad in terms of, our more types of businesses in our portfolio, because of our focus on moats and reinvestment runways, there are giant swaths of the investment landscape that we just ignore, right? And, and if your mandate as an investor is to be sector neutral to a benchmark, all right? Or if you, can't be too under or overweight because that's what your clients expect, you may have some constraints around that. And that's not bad or good, but it means that the checklist I just articulated may really not be complete, right? You may want to incorporate things around regulatory risk or around, exogenous events that could really affect the company, or balance sheet leverage, right? Which is just not really a concern for us. But if I had a broader portfolio, again, all else equal, I'd want probably, leverage adds risk. You just want to incorporate that into some kind of a quality framework, because even though like in a DCF, okay, leverage lowers your cost of capital, great. It also adds risk, right? It just does. And so you'd want to incorporate that into some kind of a quality framework, I think.
Great. Pat, probably I'll just, I think we're running out of time with just a couple of questions at this. Do you differentiate between a buy and hold decision? There's, as there's a lot of debate over the number of years, two different camps over there, but a lot of people believe, in terms of buy versus hold, is that something, that you're buying fresh and something is already in your portfolio, you would look at some, differently?
Look, I think you walk in, you buy your portfolio every day. Every day you're buying your whole portfolio. Every day you're saying, okay, I have made the decision that the capital invested in company A is the best use of capital possible relative to other opportunities available that I either own or don't own, right? And so the idea that you would hold it, but you wouldn't buy more, to me, just lacks intellectual rigor. If you don't think there's a large enough margin of safety to buy it again today, I think you need to be doing some work to find a replacement for
it. That makes sense. It's thank you. One last question, Pat, from my side and from the audience. Recently Jeremy, while he was talking to CNBC, said that US stocks are in a crazy bubble, like in 1929, and you said this couple of weeks back, and also in the recent past, that has been his on the state of the US market. Just wondering, in your investment philosophy, do you try to be conscious about where you are in the market cycle or anything like that?
No, I don't think we have any skill at it. If somebody has skill at it, more power to them. Give me the number, I'll call them up and get some advice. But I think that the question of what is the valuation of the market is only relevant if you own the market. If you're an index investor, right? We only own 12 companies, so I care about those companies. That's what matters to me more than anything else. And just bigger picture, taking a step back, you're an engineer. I think actually that was your background, Crash, right? Before you got into investing. And so, you know statistics. There's this concept called stationarity, right? That the mean and median only have meaning if the characteristics of the data set don't change over time, right? Speaking broadly. And can anyone look at me with a straight face and say the characteristics of the global economy or the US haven't changed over time? That like what creates value today is the same as what creates value in the 50s? It boggles the mind that you could kind of just look at some, cyclically adjusted PE and draw robust conclusions. It's just intellectually bankrupt in my view. Because I mean, first of all, like just look at the thing of the U.S. I mean, the U.S. is much less capital intensive today, right? I mean, the value is created from less capital intensive industries. That's not good or bad, but it's different, right? More value is created from expensed investments, as I talked about during the presentation, than capitalized investments. This affects the E of the PE that everyone gets so freaked out about. And then if you look at the famous Buffett indicator of market cap as a percentage of GDP, my goodness, think about the denominator, GDP. 40% of S&P profits come from non-US sources. Why in the world is GDP a reasonable denominator? It doesn't make any sense to me. So anyway, I think there's way too many intellectual shortcuts that are taken to sort of look at some chart that somebody took a long time putting together and it looks scary, and then drawing a conclusion from that. And right, I mean, we may be in a bubble. I have no idea. Stocks may be expensive. But if I'm going to come to that conclusion, I'm going to do it by looking at businesses. Yes. I'm not going to do it by drawing charts.
Yes. Great. Thank you.
Sorry, I got a little hot under the collar there. Sorry.
Oh, thank you, Pat. Thank you, Pat, for this wonderful presentation, being so candid, in sharing your thoughts, sharing your experiences. Really wanted to thank you on behalf of the CFA Society, and all the friends in India. Thank you so much. It's very kind of you to spare time on a weekend to us. And we look forward to hosting you in India. Hopefully, in due course, we will have you visit India and host you in person. We look forward to that event.
Thanks so much for the great questions, and again, apologies for the bad internet connection. But again, I hope everybody enjoyed it, and I look forward to seeing you on the ground.
Great. Thanks, Pat. See you soon.
Bye-bye.
Bye.